Hello, this is Doug Gerlach, founder and editor-in-chief of the Small Cap Informer Stock Newsletter. Welcome all of you small cap investors to our 2025 mid-year exclusive subscriber webinar, where we'll take a look at all of the trends driving the stock market, in particular small cap stocks. We'll talk about our top picks for the year. We'll answer your questions, hopefully, and we'll discuss the forecast for the rest of 2025 and beyond as it relates to all sizes of stocks, but in particular, our focus on small company investments. As a reminder, the handout is available in the Handouts tab of the GoToWebinar application, and the questions box is available there for you to type in your questions at any time. Joining me today is Russell Malley, who is our analyst supporting the Small Cap Informer as well, and he's in the back room and will be available to answer questions as we go. And I'll have some question breaks where I'll be able to address your burning questions at any point as well. I'd like to start off and talk about the year-to-date stock market performance, particularly as it relates to small company stocks, but also as it relates to the broader market. And we've seen something we haven't seen in practically 2 decades, and that is the rise of international stocks. Year-to-date, the EFA index, that's the Europe, Australasia, Far East Index. These are large cap stocks outside the United States, and it is up almost 20% over the since the beginning part of the year, up 17.6% to be specific. The S&P is up 6.4%, which in a tumultuous year is nothing to sneeze at, but the small caps are down 2.1% as measured by the S&P Small Cap 600. All three of these segments, as you can see, pretty much bottomed out in early April of the year, but at that point, the EFA was down 3.5%, the S&P was down 15.3%, and the S&P 600 was down 21.4% from the start of the year. So a very rough start for small caps, and to come back and only be down 2% for the year is, a pretty admirable accomplishment. Of course, as small company stock investors, this is not the performance we're looking for, but we'll take a look at these trends and what's driving this performance as we go. Investors are looking outside the United States for a number of reasons. As you can imagine, political strife and uncertainty and turmoil certainly has a lot of international investors a little bit skittish about the American markets and where it's going. And certainly as we'll make the case later, US large and mega cap stocks remained at a pretty high valuation level, those stretched valuations. I think if you're looking for growth at a reasonable price, if you're not looking to overpay, it can be difficult to find bargains in the large cap space in the United States. The weakening dollar may have something to do with it as well. As the dollar weakens, those large company international stocks will see their fortunes turn a little bit better. And when you look at non-US multinational companies like SAP and Nestle and Novartis and Novo Nordisk and HSBC Holdings and Shell, you'll see lots of opportunities for investors. Many of those companies operate in the United States as well as around the world. And so they provide a reasonable alternative in the minds of many investors to those overhyped US stocks. International stocks, I think, are a good element to add diversification to help smooth out the returns of your portfolio. It's certainly not required that you look outside the United States, particularly as in any given year, somewhere between 30, 40, and 50% of the earnings and revenues of the S&P 500 companies, and those are all domiciled in the United States, those sales and earnings come from outside the United States. So the companies get to manage the currency fluctuation and the political turmoil and weather conditions and all of the things that impact international investing without having to actually require you as an investor to hold an international company. So that's an interesting turn of events, something I wasn't necessarily expecting, but I think in hindsight, it looks pretty reasonable to see investors turning away from the United States but still there's a lot of support for large company stocks and mega caps. And if we look at the long-term picture here, you can see the EFA in magenta down at the bottom. It has been trailing for most of the last 2 decades, the small and large US stocks. The S&P 500 in blue on this graph and the S&P Small Cap 600 in orange. The reason we focus on small company stocks in this newsletter is because of that orange line on the graph here, delivering the highest rates of return over the long term, even though the recent trends have not been favorable for small company stocks. And again, we'll continue to talk on that topic. Certainly last year in 2023, the Magnificent Seven were the big stories. Not so magnificent in 2025. This graph shows the Magnificent Seven stocks as represented by the Magnificent Seven ETF with the ticker symbol MAGS, M-A-G-S. In orange at the bottom, the S&P 500 equal weight in magenta and the S&P 500 in blue. And you can see that in the last couple of months, the S&P 500 and the S&P 500 equal weight indexes have been tracking pretty closely. And that's not the case when the Magnificent Seven is outperforming. Then that will lift the market cap weighted S&P 500. So the Magnificent Seven stocks have come back around. They've since they bottomed out in April, and they've resumed that upward trajectory, but still the performance for the year to date of the S&P 500 has eased up a little bit from the influence of the Magnificent Seven that we saw in 2023 and 2024, but still a force to be reckoned with. If you were at our Outlook webinar in January, I showed you the forecasts from 17 different investment banks for the S&P 500 for the calendar year 2025. Here are those estimates on a graph. The S&P 500 ended 2024 at around 58.22, and you can see the 17 estimates here going out through the end of the year. Of course, the S&P 500 is not going to grow on a linear basis as on this graph, but I plotted there, the little star shows you the actual S&P 500 level as of the end of last week, and you can see it's right in the middle of that that array of analyst estimates for the S&P 500. So I think most of the analysts will be pretty pleased with their projections, with the exception of Stifel down there on the bottom, projecting sort of a bear market for the year. They could still turn out to be correct, so we can't discount it. But the S&P 500 is almost at the level of the lowest of the bull market predictions of 6,400, so it's 6,260, getting pretty close already halfway through the year. So interesting to see that those forecasts are still on track, and we are still on full-on bull market mode for the S&P 500, and that bodes well for investors yet again. Of course, there are always causes for concern. I like to look at the PE ratio of the market, tracked back to 1870 here, and you can see on the right, kind of surprisingly, when you sit back and think about it, that the PE of the S&P 500 is now almost at 30, at 29.83, using estimated earnings for through the second quarter. And you can see that that level is higher than just about any other normal time on the left side of the graph, from 1870 through to around 1999, at the peak end of tail end of that 1990s dot-com expansion mode of the economy. Then you'll see a couple of outliers there: the dot-com crash of 2001, the financial markets meltdown, housing market meltdown of 2008, and the subsequent bear market, the COVID pandemic of 2020, and you see the PE ratios spiking there. I would consider those outliers. But the fact that the PEs have been growing pretty steadily since peaking, or since bottoming out in 2011, I think, is just more of the story of investors looking for big returns, keeping their money in the stock market, not turning to bonds, not turning to savings accounts, but rather just simply sticking with equities and putting more and more of their cash into equities. And a lot of the calls that we were seeing 10, 15 years ago about the baby boomers withdrawing assets and the transfer of wealth, and those sorts of long-term trends haven't yet materialized. We still have a lot of assets in equities and supporting it as we've never really seen before. And so those PE ratios are pretty amazing. I zoomed in here on this graph through from 2015, so the last decade, so you can kind of get a sense once again of since the mid 2022, sort of that upward trend of PE ratios, those rising valuations, and this is why some investors are a little nervous, because you can only inflate the market so far before it bursts. And so I think that tells us a story that about the market, about large caps in particular, and as much as we know about the cycles of large versus small company stocks. When large stocks are in favor, small company stocks tend to get ignored, and vice versa. And what we're looking at is a very long period when investors like large company stocks and they're not so interested in small company stocks. And that's a secular trend that we have to acknowledge as small company stock investors. Certainly the earnings story of the S&P 500 is very strong as well. So in this graph, you can see earnings did peak post-pandemic. We had a little post-pandemic express elevator for a lot of companies to increase their profitability. That retreated a little bit, nothing out of range, and now they're slowly growing once again up to $214.07. So that's the aggregate earnings of the S&P 500 relative to its history. Yeah, pretty high, pretty strong. And that's what we want to see. We want to see growth of fundamentals, because that will translate ultimately in the growth of valuations. So no warning signs there. Forecasts still appear to be strong for the S&P 500 and corporate earnings going through the rest of the year. Of course, when you look at treasuries, there's another story in place here. These interest rates declined pretty consistently until 2020, when the Fed began boosting rates, and now they've been above 4% for for the better part of the year, and a little bit before, retreated a little bit off their highs, but still at 4.43% as of the end of the last week. That's not enough, apparently, to tempt investors away from equities and keep them in treasuries, so it'll be interesting to see. We can't imagine at this point too much of an increase in the interest rates, in the Fed's interest rates, but is a decline in the offering? We'll see. Have to wait and see. But again, another story there of rates that are kind of languishing at that 4% level, greater than 4%, for a little bit longer than some analysts had expected. And as you might expect, that S&P 500 dividend yield continues to decline. It's very close to an all-time low at 1.23%. This is a function of a number of factors. The function of high stock prices, first of all. Prices go up faster than companies increase their dividends, then the yield will fall. But also companies are increasingly continuing to not raise the dividend or to not use capital to pay dividends, but instead are buying back shares, something that they can do with their excess cash that benefits shareholders but doesn't commit the company to paying an ongoing dividend. They might also be paying down debt. which is a good sign and a good way to use capital. But I like to point this out. I see a lot of investors on online forums, a lot of young investors in their 20s who want to know about dividend strategies. If you're investing purely for yield, this is not going to get you to your financial goals. If you're looking at a growth, capital appreciation plus yield plus capital return strategy like we use in our dividend deformer, I think that makes a lot of sense to limit your volatility while still earning a very respectable rate of return, perhaps not to exceed the market's rate of return, but something that you can definitely sleep at night knowing that your stocks are working for you, that there will be cash coming in from those holdings. But chasing yield to me just seems like a fool's errand increasingly. Well, in the last issue of the newsletter, I devoted many pages, so forgive me if you thought that was a little wordy, to small cap stock dynamics. But I thought halfway through this 2025 year, the 13th year, coming up on our 14th anniversary of the Small Cap Informer newsletter, to look at take a bigger picture view of the trends that drive small company stocks, as well as the broader market. And the underlying question is, why aren't small cap stocks performing better? When we look at the craziness and the turmoil and the uncertainty that affects the economy and the market and through every strata of society in the last year plus, why is it the case that small company stocks are not getting any of the love that large company stocks are getting? That's the underlying question that I was trying to answer there. So let's go through and step through and provide some additional color to that commentary and give you a sense of where I stand in terms of long-term secular trends and near-term headwinds and tailwinds that impact the small company stock market. And investors love to generalize. People in general love to generalize. And so investors are going to lump together small companies regardless of the fundamentals. And we at the Small Cap Informer, we take great pride in separating our strategy and describing why it works better than other strategies and why our approach is something that you should consider. And we have the bona fides to back it up. We have the track record that satisfies our objectives. But for the rest of the market, we're just small cap stock investors. We're just another small cap service, and there aren't all small cap investors looking for the same thing. That's not necessarily the case. And so I still believe pretty strongly that our approach at aiming to mitigate many of the concerns that investors have about small cap stock investing is really a very sound approach to the market. But it's also frustrating that a lot of investors aren't concerned with fundamentals. A lot of investors are looking at the stocks as if they're voting on a popularity contest. They're not focused on the true fundamentals. And even the Better Investing Top 100 or the Maya Club Top 40 stocks that Better Investing members and investment clubs that ostensibly are using the stock selection guide to purchase are largely overweighted in mega cap, large cap stocks. And I find that a little disappointing that out of the Better Investing Top 100, there may be one stock that meets Better Investing's criteria for being a small company. So why is that? And I think that investors, are subject to the same whims and fears, whether they're a Better Investing member or not, whether they're in an investment club or not. Doesn't mean that they can't be successful with that large cap approach. And certainly the last 2 decades have shown that you can be a narrow focus investor only holding the widow and orphan stocks, the blue chips, the large caps, the mega caps, and you don't have to worry about diversifying down the company size categories. But that's not always going to be the case. And it sounds like a broken record to say that the tide will turn, but I still believe that will happen, and when it does, our picks are going to rise to the top. We've had a couple of years where our returns and the returns of small company stocks in the last 13 years have outperformed large cap stocks, but by and large, it has been a decade and a half plus of large cap dominance. So already, as you've seen, small caps are lagging large caps in 2025, just like they did in 2023 and 2024. And those mega cap stocks, the Magnificent Seven, and there are probably another couple dozen uh, ultra large cap, mega cap companies that are hogging the spotlight, and they just drain all of the investor enthusiasm for other sub-asset categories in the equities market. The trends and drivers that boost small caps just haven't been in place in the last couple of years. So I think that's all part of the normal course of things. There's no rule that says that the trends should shift every 5 to 7 years. I mean, we look historically and we see long periods, but sometimes those periods have been 7 or 8 years where large caps outperform small or vice versa. So the fact that we are in the midst of a long, large cap dominated market is not concerning. Small caps are just caught up in that cycle in my perspective, we'll say. So when we look at debt and interest rates, leverage can boost companies' growth. I am not um, an investor who says debt is bad. Avoid companies that don't have any debt. You look at it on an industry basis, you look at it on a company by company basis, you see that well-managed businesses can use debt to leverage and grow faster than they can without it. And that's terrific. And in the low interest rate markets of the last 15 years, 10 years heading into 2020, and after that, you see a lot of companies taking advantage of borrowing and that's contributing, I think, to the ability for the S&P 500 companies to grow their earnings even more because they've been able to borrow capital at dirt cheap rates and use that to grow their business. So if rates remain at these higher levels, that can certainly stifle growth and trim profitability for a lot of companies. And the overarching theme for small companies with respect to debt is because they're small companies, because they don't have as long or as robust track records, because the amounts they might wish to borrow are significantly more than their equity compared to larger companies. Small company stocks pay more to borrow. They borrow at higher rates. They use more floating rate debt. They borrow shorter term debt that they have to refinance. Last year, floating rate borrowing accounted for 45% of the debt of Russell 2000 companies. Only 9% of S&P 500 companies used floating rate debt. That tells you right there that the cost of capital are going to be much higher for small company stocks. And with those low rates of the last 5 years that we saw, back in the 2020s, a lot of that debt that was taken on by smaller company stocks now needs to be refinanced, and the cost of refinancing is much higher, and that will drag down earnings for smaller companies, to be sure. Our approach to this is that because we don't eliminate companies that have higher levels of debt, but the reality is that most of the companies we follow carry low levels of debt. Not because we're targeting that, but because when you look at all of the quality standards that we apply to management, they tend to be more disciplined borrowers. They're not going to borrow money unless they've got a plan for it, a plan to pay back. They've got the cash flow to support it. They have a practical plan for using that capital to grow the business. So those are all elements of management that we can identify, we can pinpoint, and we can say, yep, this is the kind of company that we like to hold, where we know we can trust the management team. So from our perspective, interest rates, whether they go up, go down, tend not to have a major impact on the company performance, other than from a perception basis from investors who, again, have categorized all small companies together into one basket. And so if interest rates go down, small company stocks are going to suffer and they shouldn't be see their prices go up, right? And so that over categorization hurts small company stocks. But still, there's an expectation that interest rates are going to decline from where they are now, and that could certainly, again, act as the tailwind to support small caps and their prospects as we go forward. And even as you know, the market would love to see rates go down a little bit, perhaps on a controlled plan. And Morgan Stanley, I was surprised to see, is calling for 2 rate cuts in 2025, but they're calling for 7 rate cuts in 2026, seeing the need for rates to start coming down, not seeing the need to keep the rates high to temper inflation. And that is a pretty phenomenal call from their point of view. But again, there's nothing in the economy that would preclude that at this point to see those rate cuts going through. I would love to take the politics out of it. I don't think we need to have a political oversight of the Fed any more than we do now, and the Fed should be able to manage rates to the benefit of the entire U.S. economy, and not just to support people who have invested in stocks and publicly traded companies and corporate businesses that are just looking for cheap sources of capital. So if rates do come down, that would likely be a tailwind for small company stocks. History says that, you know, when rates come down, that first drop, small company stocks will get a little bit of a bounce. So we can look forward to maybe a little bit of that later in this year. But again, the material impact on the types of companies that we cover is probably not going to be so great. When we turn towards expenses and costs of goods and services and labor, we can see that wages are coming up, and inflation is kind of sticky where it is. There's some people would like to see inflation a little bit lower. I think it's probably in a good place. And if inflation decreases, it doesn't mean that prices go down. But this minor detail is lost on a whole lot of investors. It just means that if inflation declines, it means the prices aren't going up as quickly, which I think we can all say would not be the worst thing in the world to happen to the economy. And certainly a lot of companies would benefit. But the profits of small company stocks, as inflation remains sticky and labor costs are going up, becomes more difficult for management to handle. And to how difficult that is for small company stocks, if you look at the S&P 500, this table on the right shows you companies, the share of companies in the indexes of the S&P 500, the Russell Mid Cap, and the Russell 2000 with negative earnings compared to positive earnings. So the S&P 500, 6% of companies at the end of near the end of 2024 had negative earnings. 14% of the Russell Mid-Cap had negative earnings, and 42% of companies in the Russell 2000 had negative earnings, and that's pretty phenomenal. This is one of the reasons why I like the S&P SmallCap 600 index as a better representation, because those companies are by and large going to be profitable. They're selected because of their the strength of their management and the representation of well-run small companies, as opposed to the Russell 2000, which is purely by market cap. So it's interesting to see, and something that we keep track of, but certainly in the Small Cap Informer, our focus on quality of management really allows us to see companies, invest in companies that are managing those rising costs. They're managing labor costs and energy costs and costs of goods and services and raw materials. They're doing a good job at it. And so that gives them the ability to manage their pricing and maintain their profitability and defend their margins over time. And so this is why we focus a lot in our quarterly updates of companies on how well they're delivering on the margin side, both on a gross and on a pre-tax and net basis. that gives us a sense of, is management doing the job? And it's been pretty remarkable in the last 3 or 4 or 5 years to look at our small company coverage list when many other large caps were posting losses, to see our companies kind of quietly chugging along, doing the job that they're supposed to do, which is make money for shareholders. So, and the bottom line here is that if a company is able to be successful during difficult times, then when the tide turns, they're going to really be able to shine. And so we have a lot of pent up optimism in the coverage list right now. Companies that are just quietly going about their business. Uh, we have only a couple of companies that have stumbled, that are posting some negative losses. Sometimes those are one-time non-recurring events, but by and large, profitability remains the word of the day. When we talk about small company stocks, one of the things that we need to address, and one of the questions I frequently get from investors is, there are no analysts covering many of these small company stocks. Large caps are out there having 40, 50, 60, 80 analysts covering the mega caps and the Magnificent Seven, while you look at a small company stock and there will be 1, 2, 3, or no public analysts covering those particular companies. And this is a factor of both the regulation of mutual funds, for instance, the practical aspect of managing a portfolio for clients where high net worth individuals might not be as interested in small company stocks, because in order to maintain a healthy exposure to small company stocks, they need to have a lot of them, and that's not always very pragmatic approach. And so without that institutional interest, we don't have the drivers of price growth for small company stocks. But small company stocks, if they do their job well, will become mid-sized company stocks, will become large company stocks, will be covered by more and more analysts, and we'll see more and more institutional interest. But in the short term, we're playing the game before the other players are at the table, in the hopes that we get a little bit of an edge at some point down the road. When we talk about investor or valuations of small company stocks, I often refer to it as measuring investor sentiment. A PE ratio, well, what does it tell you? It tells you how much investors like or dislike a particular company. And the fact that small company stocks are running under the radar leads to many inefficiencies in pricing, which we attempt to exploit. We have opportunities to buy stocks at reasonable PE ratios, because the big players aren't allowed or are not interested in investing in our space. And so again, this gives us a long-term edge, but in the near term remains a little bit problematic. And you can tell people that it's not always going to be the case that mega cap tech stocks are going to be dominating the market. And people say, well, look at Apple. Yes, but there have been plenty of other large company stocks. Look at the history of the Dow 30. How many of the 30 stocks that are in the Dow Jones Industrial Average right now have been in it for since the start? The answer is none. Right? It's been reconstituted many times, and there are few companies that have been in it for more than a couple of decades. So those were supposed to be the stocks that were going to last forever, but nothing lasts forever, as it seems. So I see signs of interest in small company stocks kind of percolating below the surface. I see signs of this mega cap dominance. Absolutely, earlier this year, we saw investors kind of lose favor with the Magnificent Seven. It's since come back a little bit, but we still have some pretty major problems, and it's very difficult to start making a case for many of the mega caps. Certainly when you see a 20% drop in NVIDIA, it can be enticing. And if you can purchase those stocks at discounts, that would be advantageous, but you just don't get the opportunity to. On the small company side, though, we continue to see pretty remarkable discounts for small caps compared to large caps. Here are the projected PE ratios of the S&P 500 compared to the S&P Small Cap 600. Right now, the projected PE ratio of the S&P 500 is 22.45. For the S&P Small Cap 600, it's 15.32. And the S&P Small Cap 600 has a higher projected earnings growth rate than the S&P 500 companies in the aggregate. However, investors are interested in large caps and they're not interested in small caps. The sentiment's not there, and so that gap is pretty low. This is a pretty busy graph here. This is the relative forward PE ratios for the S&P 600, 500, and 400. And if you look at divided by the S&P 500, so these are relative PE ratios. The green is the S&P 600 divided by the S&P 400. The red is the S&P 600 divided by the S&P 500, and the blue is the S&P 400. That's the small cap divided by the S&P 500. And so you can see the gap there as those the S&P 400 and 600 relative to the S&P 500 have dropped off pretty consistently over, going back to 2010, 2011, but precipitously in 2021 into 2022, and they've been languishing down there. So another way of looking at it, small and mid cap stocks right now are 30% cheaper than large cap stocks. That's a pretty remarkable gap. And so another way to interpret this gap and this chart is to look at the gap right now on the right side between the red and blue and the green at the top. And you can see going back in time, those gaps have not been that narrow. Going back into the 2010 to 2014, the small and mid-sized companies were outperforming the S&P 500. Here's another similar graph that shows you the S&P 400 divided by the S&P 500 in blue. So the relative performance of the S&P 400, and the bottom is the relative performance of the S&P 600, the small cap index. So you can sort of see some trends there. But what's interesting is that since 2021, both those indexes, the valuations have declined, and so now we're getting back on the small cap side, the red side, we're getting back to valuations that we haven't seen in 20, 25 years, that level. When was the last time we were, above that 0.2 level? Go back to 2000 and after the last recession, coming out of the recession in 2001. So you can see, but the trend is moving down again. So that means valuations, the relative valuations of small company stocks is going down as opposed to going up. Another way of looking at that is there are more and more opportunities in small and mid caps than in large caps in the current environment. Which, raises the question. We had NV5 Global recently made an acquisition or merged with another business, and couple of months ago. Last year we had a covered stock, Shutterstock, which was acquired, and we've had a few random acquisitions over the years, and you have to wonder why. If we are looking at stocks that have good prospects and low valuations, why aren't some of these companies being snapped up by larger businesses or taken private in private equity, which would be probably a really nice exit strategy for many of our positions. But that's a question that I can't really answer. It's a mystery to me. But having said that, this graph on the bottom shows in the bars are the value of deals in US millions of dollars, and the line is the volume of deals. And on the right side, you can see in March and May of this year, the deal value bumped up quite a bit. There's actually a lot of action in the IPO market in 2025, which seems counterintuitive if you look at the uncertainty and turmoil in the broader market. Why would you want to go public? but there are a lot of trends in place, and there's a lot of capital available to take companies public, and the appetite for investors for those new offerings remains strong. So this could be a tailwind for some of the companies that we track that could become acquired. We're seeing more and more of the small companies that we track that are acquiring other businesses, which is kind of interesting and growing in that way. But so there's a potential, remains a potential there for more and more of this type of mergers and acquisitions activity going through the rest of 2025 and into 2026. So if interest rates were to fall a little bit more, that might make private equity more accessible to those types of buyouts, but they have plenty of financing opportunities available for them. Our approach to the valuation of stocks is got a heavy contrarian attitude about it. You know, we know that other investors aren't looking at these companies, and we know we have a strong value bias. We like to buy stocks when they're cheap, as long as the company fundamentals are strong. And we know that eventually the market will always come around to recognize bargains, recognize quality, and that is where our return will come from. But it does require patience, to be sure. So let me talk about the economy and the trade trends. There is a hypothesis that all of the struggles around the US's global trade policies and tariffs are helping small company stocks that are more domestic centric, that are more focused on manufacturing within the US, that are not exporting a lot or importing a lot of raw materials, that those companies have what you could call home turf advantage. And it's certainly true that more small companies are able to perform that way. If you're a large company, you know, like Apple, and you want to build you want to do more manufacturing in the US, it's billions of dollars to build the facilities that you need. The raw materials may or may not be available. You know, it is a major complex endeavor. On the small company side, it may be much more practical to take advantage of opportunities onshore as opposed to in the export market. So that's a bonus for many of the smaller company stocks that we track. Certainly the onshoring trends, supply chain localization, those are gathering momentum, continue to gather momentum. I think if it wasn't for the pandemic, many businesses in the US today would not be surviving. But because we went through the pandemic, because we went through a period of 6 months when the ports were relatively closed or so jammed up that companies couldn't get the raw materials they needed, couldn't get at the imported goods that they needed, didn't have products to put on the shelves in their stores because the import lines were all stopped up, and so had to maneuver around those issues, that now facing these new global trade restrictions, those companies have been able to, you know, they've already begun the process. They have plans in place or contingency plans. They diversified their supply chain so that they weren't dependent on Asia exclusively, that maybe now they've got, you know, Mexico and India and Southeast Asia, as well as China, where they can source goods and materials. And so I think that's helped a little bit, but that still doesn't make it any easier for those companies to deal with those issues. But small companies do have a little bit of an edge there. They can be more nimble, more innovative, and if they're in emerging industries or they're in industries where they can really capitalize on those onshoring trends, that's a big bonus there. When we look at consumer spending, you know, we hear lots of dire tales in the news about the economy, but Americans, and we also hear stories of how consumer sentiment is really low. Americans are just not very happy at all. But on the other hand, they're not happy. They're certainly continuing to shop. They're continuing to buy goods. They're not buying big ticket items. The RV market still is constrained. The home building market is still got issues. Those industries are still nowhere near recovering to some of the heights they'd seen, in the last 5 years. But we see a slightest tapering on the right side of this graph of U.S. Consumer spending, but it is still upward. And when you compare the drop in 2020, 2021 there, the pandemic-driven pullback in spending, but the recovery was quick, and spending went on to new heights, and it's been growing consistently ever since. So I think, that's a good sign. It's just also proof that people often say one thing and do another, right? They say they're worried, and then they go out and go shopping. Then they buy things that on their wish list. They're making big ticket purchases. There might have been a little bump up earlier this year. People were worried, oh gosh, we need to replace our refrigerator. Maybe we should buy it now rather than wait. Maybe we won't be able to get it. Maybe it'll be 30% higher because of tariffs, right? And so there might be a little bit of that built into it. But the bottom line is that people are still spending, and that it behooves well for the greater economy. Our focus in terms of domestic versus international, we largely focus on companies that are in the US. I did a quick tally, and 70% of the revenues of our coverage universe now, 40 companies, is derived domestically, right? In other words, in the United States. 11 of 40 companies have less than 50% of their revenues that come from the US operations, but many of the companies are solely located in the United States. We have a handful, one or two or three that are located outside the United States. FIA, the Brazilian healthcare company, 100% of the revenue comes from Brazil. Even Air Lease, steadfastly American business, but something like 95% of its revenues come from airlines outside the United States, which is, again, that's fine. Fabrinet is another company, the semiconductor stock, that sees a lot of revenue coming from outside the United States, but that's what happens. We don't make semiconductor chips in the United States. So a business that makes tools and equipment, foundry, and all of the services that go into manufacturing semiconductors are going to have customers outside the US. Not like the end products. We're big consumers of chips. We're just not big makers of chips. So it's some interesting findings there about our approach to the global versus domestic companies. Global stocks, on this slide, that should say global stocks not necessarily required for diversification because of the fact that large cap US stocks typically generate 35, 40, 50% of their earnings and revenue from outside the US. So let them handle it, right? Let those companies manage the currency conversion and all the other aspects of running a business internationally, instead of us trying to buy a company and then buy a foreign company and track it here in the US. Even if it trades as an ADR, there's still issues that we have to address. We have to be aware of the impact of currency, for instance. With the weakening dollar, since the beginning of the year, a foreign stock might see its value in terms of the US dollar go up 10 to 12%, even if the stock price in its native currency doesn't go up at all, simply because of the impact of the weakening dollar. So the companies that are most impacted by tariff and trade policy get monitored pretty closely. We had Five Below, as you know, on our probation list. We just wanted to make sure that they were going to be able to source their goods in a tariff-ridden, limited import world where where price is it's in their name, five below, right? So if prices go up and they can't sell as many goods at below that $5 price point, then the company's got a problem. So we think it appears they've been able to turn around and adjust their product mix, bring in new management. They came off our probation list, but those are the types of companies that we watch pretty closely, and we'll try to keep you up to date on in each issue. So when that market does shift from large cap tech dominance, investor capital is going to start flowing back to small. Analysts are calling for stronger earnings for the Russell 2000 and the S&P Small Cap 600 in 2025. So still a lot of optimism built into the market despite all of the turmoil. And so I think there is time. There are plenty of opportunities, I think, in our coverage list, and we'll address some of those as we go. Of course, it's not all rosy. There are always headwinds and risks to watch out for besides, tariffs and import and the global economy, inflation, the fact that it's kind of sticky and, resurging a little bit here, a little bit there, that could cloud the outlook. Recession fears have largely eased. The news writers have other things to talk about, including politics and tariffs and trade. And so they haven't been focusing on the recession. Not much has changed, but not much has changed in the last 3 or 4 years since I told you that it was unlikely that we were going to have a recession in the United States. And that's still my position at this point. There's still so many things going well, and the economy is doing a great job of absorbing shocks to the system and finding new highs. And here we are back with the S&P 500 finding new highs. Higher borrowing costs, those rates don't come down. That could weigh down some businesses. If we do have a pause in real GDP growth, then we could see those corporate earnings start to retreat. And we wouldn't like to see that. Trade tensions, political strife, tariff threats, the drill, could all dampen overall investor sentiment and have a greater impact on small caps when those things happen. And yes, I'm seeing some signs of broadening interest beyond mega caps and large caps, but they could still overpower small caps as we go through. We don't talk a lot about volatility. We're not really interested in it. We acknowledge that our stocks have a higher beta than most of the many large cap focused investors are gravitating towards, but hopefully we'll have a payoff at the end of the day that makes that volatility worthwhile. And we continue to look at that buy on the dip mentality, focusing on looking at stocks selling at reasonable valuations and taking advantage of any sort of price decline or volatility decline. So there could be a resurgence for small caps on the way up. I'm going to go out on a limb and say this is looking more and more likely. If not this year, then maybe next year. Certainly all of these factors, the attractive valuations right now, some interest rate cuts and market rebalancing. If some of those large cap investors decide to thin some of those positions and move down market into the mid and small sect spaces, then that would be positive. We always are vigilant, watching the volatility, acknowledging the risks, but there's nothing in the market, there's nothing that we've seen this year or last year or in the last 15 years that changes our approach to focusing on quality, on robust fundamentals, on stellar management, and we think that those are the aspects that will drive company performance as we go forward. If you have any questions, please feel free to use the questions box. I'm going to give you a quick update on the performance of our picks through June 30th, 2025. A reminder, we measure our performance on a compound annual return basis compared to the S&P Small Cap 600. We acknowledge we're not in the business of outperforming the broader S&P 500 or the overall market, but we do believe in the positive positives that small company stocks bring to the average investor's portfolio, and believe you should maintain exposure to the small company stocks as part of your long-term portfolio. Uh, when the market goes down, we expect to go down along with the market, but hopefully not as much as the overall market. That's been the case so far for most periods when we've seen the S&P Small Cap 600 decline. We don't decline as much, or as we've done this year to date, our picks are actually up year to date 2%. Which doesn't sound like a lot, but when the S&P 600 is down 10% year to date on a compound annual return basis, we'll take it. That's a much, much better performance on the year to date basis. When you look at the lifetime, the 3-year, the 10-year on this graph, over the lifetime, our performance is twice that of the S&P 600 on a compound annual return basis. And I think, can't ask for more than that. How much better do we have to be to justify a subscription? On the 3-year, we're edging ahead. On the 10-year basis, we're way ahead, 6.6% compared to 1.9%. And yeah, we get it. These are not great overall rates of return for an entire portfolio, but for the small cap sector of your portfolio, these are better than a random assortment or an ETF in the small cap space. So we think that's a pretty positive sign. Every year we do a top small cap stock picks special report for subscribers at the beginning of the year. It's an exercise in taking a look at stocks that perhaps may get overlooked since we recommend them. And we recommend a stock. It's a point in time. The stock price may go up, it may go down, and sometimes even if it goes up, the stock remains in the buy zone, but because it's higher than when we recommended it, subscribers might stay away from it. So we like to try as an exercise to point out the opportunities that exist in our existing coverage list. That if you take the spreadsheet and you sort it by total return and do some analysis on those top return candidates, you can often find opportunities. So our list for 2025, halfway through the year, it's overall it is marginally acceptable, I will say. 3 of the 5 stocks are down. 2 of the 5 stocks are up. The biggest stock is up 32.6%. That's Palomar Holdings, which remains one of our top total return picks right now. Inter Parfums, the global high-end fragrance and business, up 6.5%, paying a decent dividend. And then Mtron, the electronics components defense contractor, down 18.6%, really just on the back of a poor fourth quarter. But the company is so small that a $10 million order that comes in after the close, in 3 days or 4 days, to see that order come in and not get booked in the quarter can cause big swings, and it's a thinly covered stock. So it's still one of my top picks right now. And interestingly, the fact that it's defense contractor seems to have been to be cause for optimism. So there's some good trends in place for Mtron. Lantheus Holdings, the radiopharmaceuticals business, I think has taken a hit because it's losing market share, because at one point it was 100% of the market, and no company is going to be 100% of its market for very long before competition is going to start creeping in. So we're seeing a little bit of that erosion. We had been seeing hopes that some of the new Medicare, Medicaid rules for reimbursement were going to support the business, and then now we're looking at Medicare, and Medicaid rules, perhaps clamping back down and covering fewer people. So a healthcare company like this is going to be caught in the crosshairs of that. And then Intest, the tiny semiconductor equipment business, again, just in terms of what's happening with the semiconductor industry and chips and imports in China and Asia, and just a lot of uncertainty there that just hasn't panned out for the particular business. And it is one of the few stocks that we track that is uh, below $10 a share. And so that puts a little bit of additional pressure on it. I still am long-term optimistic about Intest, but it's going to be could be a couple quarters more of pain before they start to turn around again. So the average percentage change with dividend since the beginning of the year for these 5 stocks, down 0.4%. That's better than the S&P Small Cap 600 index, which is down 0.6%. So holding its own year to date. We'll see how things line up by the end of the year. Here's a graph just to show you those same values. That's the fun part of being an investment. I see that Srinath asks, is it worth picking small cap technology stocks given the AI trend? Yeah, that's an interesting, um, whenever we start talking about AI and trends, I like to go back over the last 20 plus years at all of the trends that were supposed to revolutionize business in the market and who benefited and profited from those trends, starting with things like blockchain, which were a big buzzword, and cloud computing, another big buzzword, and software as a service, and all of those technological innovations got deployed in different ways, but they became part of the framework of business for many companies. And the large company stocks, the large caps, were the ones that capitalized the most. Even today, if you say, who are the big players in cloud computing? Well, there are no small companies. I mean, some small companies are going to benefit from it, but the biggest players are, Amazon, they're Microsoft, they're Google. Those are the biggest cloud computing remote, and Meta is in on the business act as well. So in terms of will AI replace a lot of the services or product development that come from small company technology stocks? Are they going to be wiped out by AI? And I think that's a little premature at this point. I think I think there's opportunities, but it's hard right now to parse the buzzwords from the reality. And when you look, FactSet does a great job of tracking, corporate earnings calls, and will tell you, this quarter, this percentage of corporate earnings calls referred to artificial intelligence or Gen AI or historically going back, all these other different trends that you had to address. We've had some ludicrous AI uh, uh, posturing that's been done by a lot of companies and a lot of investors. It's hard to see some of the companies that claim to be deploying AI, how it could possibly serve their business in any sort of meaningful way. Not to say that they couldn't do it. So it's going to be interesting at this point. Much of what the companies that we are following are very practical. They're making not so much technologies as goods, industrial manufacturing components. And so I think, those businesses could be aided by AI, but I don't think that they're going to be replaced by AI or AI-driven technologies, at least not in the near to midterm future. Hopefully that answers your question. Let's talk about the recent best for new money picks from the latest issue, just to kind of run down and give you a sense of my thought process. Alpine Income Trust now has a 7.9% yield, real estate investment trust, so investment clubs should stay away. But for individual investors, 7.9% yield plus capital appreciation. They've been recycling assets, so selling lower quality assets. They had a lot of Walgreens properties that they've divested, sold those, and are buying better performing retailers' properties, which they then lease out those spaces. And I think there's still plenty of opportunity for this particular company, but that yield shouldn't be overlooked. Last month we covered Catalyst Pharmaceuticals. Still has a lot of catalysts for growth in my perspective, being down a little bit, but I'm still thinking that the rollout of their current rare disease portfolio and global expansion has a lot of opportunities to it. The healthcare space is kind of tricky right now, especially with expected cuts to Medicare and Medicaid. And certainly the next company here, MedPace Holdings, is a contract research organization seeing their pharmaceutical companies, their customers, postponing or canceling testing and trials and other services. And I think those companies are just being a little defensive. They're being protective because they're seeing the uncertainty and they're not willing to go out too far on a limb. So that's holding back MedPace a little bit. They had reduced their guidance for the year. But even that soft guidance they gave, if they exceed it by a little bit, would trigger some near-term upside. And I think long-term, the business model remains sound. And as we have seen in the last 30 or 40 years, policy changes in the US regarding healthcare tend to come and go. So I think the longer-term trends remain strong. I mentioned Mtron Industries. Even in the month of June and July, they announced, contracts of something like $13 million. And this is at $40 to $50 million a year business. I mean, those are enormous backlogs that they've got now in place that they're servicing and getting out. I think that there's still a lot of opportunity there. The company tends to see its shares bounce around, being a very small business, but I think there's opportunities there. Powell Industries, the electrical equipment components maker, I still think there's lots of potential there. They remain pretty high up on our total return list, even though they perform very well for us, and I think is a nice industrial diversification business. This is probably a great company to consider. And then Royal Gold was our focus stock in June, just looking at gold prices and looking at this company's business and the decisions that they've been making. I'm just very impressed with it. They made a big acquisition in July this month or late last month, and saw their price. The market did not like that acquisition at all. I think it will continue to, that acquisition will continue to drive the company's business. I don't think there's necessarily a bad side of it. I didn't see that they were overpaying for the business they bought. So I think the prospects are still pretty strong. A little bit of a defensive hedge if you're worried about the economy. I think it's always a good idea to have a little bit of gold, the gold mining stocks, gold streamers like Royal Gold in your portfolio, just as a hedge against currency and hedge against economic downturns. So I'm still pretty optimistic on it, and at that reduced price, and again, we'll do more of an analysis after their next quarterly release, where we'll take a closer look, a deep dive at the acquisition and the combined financials, and just see exactly if the growth trajectory is where we want it to be. But I'm thinking that this is still a reasonable opportunity at this point. So with that, we're going to wrap it up. I want to thank you. We're just over our hour allotment of time, but thank you for being a subscriber. Feel free to email me with comments, with suggestions, with questions. We love to know what we can do better, what we can do differently, what would serve your interest as you build out your own portfolio. As always, I wish you the best in your equity portfolio for the rest of the year and for the long term, and I'll look forward to seeing you in our next webinar, or perhaps in a live presentation some point down the road in the rest of the year. I've got a pretty busy schedule coming up of a lot of appearances at chapters around the country at our new initiative with AAII. I'll be doing monthly webinars with their team where we're looking to expand our educational focus and reach more Americans with the good news about investing using better investing tools and products like the Small Cap Informer. Thanks again, once again, and we'll see you next time.